Hi, and welcome back again to Tim Bingham's Options and Volatility newsletter. We'll be taking a look today at a simple, straightforward buy right trade on the triple Qs, which is buying the triple Q and selling a at the money call, but comparing it to Friday's close after this huge run up in implied volatility and big drop in the triple Qs versus back in early June. The last time really the triple Qs, the NASDAQ 100, was trading at a similar price, and how that affects the pricing on the buy right, how you can get a much bigger downside cushion now and a much bigger potential return. So let's jump in and take a look. So here was the last time triple Q was at virtually the same price we're trading at now, literally within pennies, was early June. We're going to use June 2nd as the last time. So taking a look at the June 2nd pricing, you can see the triple Q 354.65, right? 35 days until expiration, and we're using an at the money call with the triple Qs trading at 354.65. The at the money call, which is the closest strike price to where the triple Q is trading at, is the 355 call, and that call trading at about $8.10 midpoint here. And the Vixen, which is a measure of the implied volatility, is very similar to the VIX, if you will, of the NASDAQ 100, trading under 20 at 1929. You can see that by doing this trade, right, your net cost would have been 346.55. How do we get that? 354.65 price of the triple Q if we bought it, less the $8.10 premium we would receive by selling the call, right? So we're basically capping off our upside pretty much at where the triple Qs are trading now, but protecting our downside, and doing so by about 2.25%. So if we would have gotten assigned on the trade back then, which would happen if on July 7th expiration, again, that's 35 days to go, if the triple Qs basically rose at all, if they were 355 or higher on July the 7th, we would have been assigned on the trade, effectively out of the trade at 355, right, our short strike price. Our net cost initially on the trade, as we talked about, 346.55, right, would have given us a 2.44% net gain. That would have been simply the initial cost at 346.55, right, less the 355 we're out at, so the 845 net gain divided by that 346.55 initial cost gives us that 2.44 percentage gain. If we annualize that, that equates to a little over 28% annualized gain. Let's fast forward to Friday's close. We can see the triple Q virtually at the same price as it was back on June the 2nd, right? 354.60 versus 354.65 back then, so virtually the same, basically a nickel difference. So the Qs are actually a nickel lower now, right? 35 days to expiration, right? So it's the same time to expiration on the trade, but because the Vixen now is at 25.31, it is over 6 points higher than when it was back on June the 2nd, right? We can see the at the money call now is at 1070. Here is the November 355 call, which is the at the money call with 35 days to go, with the triple Qs roughly at 355. That call is now trading at 1070, right? So what does that do to our return and protection here? So by being able to sell that call at 1070 instead of 810, right, you would be able to pick up much more downside protection, now over 3%, right, versus just over 2.25% back then, right? Your net cost is now 343.90, so much lower net cost than the 346.55 back then, even though the triple Q is at the same exact price for all intents and purposes. So if you would have gotten assigned On this trade from Friday going out 35 days on November the 24th, right, you would pick up an $11.10 net gain. Again, that's simply the net cost, right, the 343.90 up front, less the 355 strike price we are short. So we'd be able to buy it here, and if the Qs are above 355, we end up selling it at 355. So that would be a 323 percentage gain on the trade. Compare that to back then, a 244 percentage gain on the trade going back there. So almost a full percent more here for basically the same trade. And if you annualize that, right, you'd be looking at almost a 40% annualized rate compared to back then, something that was trading under 30%. So a much higher annualized return of almost 11%, all because we've seen the VXN, right, jump over 6 points higher from back in June until now. Everything else, right, remains the same. We see the triple Q price virtually the same price. It's a nickel lower, actually, right? We see 35 days to expiration, exactly the same, but because of this huge lift in implied volatility, we're able to get a bigger downside cushion, right? So more downside protection, and because of that, a bigger upside potential gain on the trade. So this is why jumps in implied volatility, whether it's the VIX if you're using the S&P 500, or in this case, the VXN with the NASDAQ 100, can be a benefit to the buy right strategy. So hopefully provide some insight into how we look to go about hedging and doing other mechanisms here now at options and volatility. And as always, here's the good trading. Take care.